And then the Federal Reserve just came out recently and said, hey, guys, we expect a slight recession. And if you're anyone like me and you hear slight and the Fed saying slight and they said transitory and we saw what happened, you have to be nervous about risk assets in the future. And that's where I am. I honestly think that stock market's getting ready to have a second half that is going to be atrocious. And my guess is it drags down crypto as well.
Gareth Soloway is back. He is the chief strategist of InTheMoneyStocks.com and president of Verified Investing Education. Gareth, so good to see you. The audience has been waiting for your return on my show. You were the first guest on my new show. So thank you for coming back. We want to get your updates on Bitcoin, the stock markets, and much more. How are you?
I'm doing really well, David. Thanks for having me back.
First order of business, we have to talk about this big rally that we've seen in the risk assets. We know that Bitcoin is correlated with stocks, so we're going to talk about both asset classes. In our prior discussion, we did talk about your outlook, and you had said the worst case for Bitcoin would be to go down to sub $10,000. Now, it's continued its rally. So let's talk about what happened. Let's talk about the strength that we've seen and why we saw this strength, and then we can get your projections forward.
Sure, absolutely. So as of now, anyways, Bitcoin remains just underneath a major technical level, this 30,500 level. We've hammered on it. We can see, in fact, on the chart right here, lots of resistance. We've tried to push above it. Each time we're failing, at least at this point. Yesterday, we pulled back pretty sharply and then rallied back today as there's kind of a risk-on attitude back in the market. But the bottom line is this 30,500 level. Number one, it's an even number. So it's anytime you get above a 30,000 or a 40, there's always going to be a tendency to get kind of the last people in the trade, which weirdly enough is not the best thing, because once you get those last people in, you don't have a lot of new buyers. And so I think that's what's happening here with crypto. We're into this level where if we zoom out, this was the low from the 2021 bull market cycle. And it was also the low right here. And we've basically done a round trip. And I know I have a lot of lines on the chart, but we've done a round trip from that breakdown, which occurred in June of 2022, all the way back to where we are right now. So again, if we look back here, and again, this area here to here, that's where we're hammering on right now. And to me, that's a huge psychological level. And it's also a level where it will pivot me into thinking that the low is in. If we successfully hold above 30,500 for multiple days, I'm really looking for 5 to 7 days, then to me, you probably do have a low on Bitcoin in. As of now, I'm not convinced of it. I still think this is a bear market rally. I still think there's more shoes to drop in the risk asset market.
Yeah, that was my next question, whether or not this rally has changed your short-term direction. I know you're a long-term bullish, and we can get to that, but I know short-term you have been bearish on Bitcoin. The rally, though, has that changed your mind?
No, the rally hasn't really. I mean, again, if we look back at the bear market of 2017, 2018, 2019, I mean, we had rallies from 3,500 all the way back to 10,000 and then back to 3,500. So you've had these bounces in Bitcoin that have actually even been bigger than what we're seeing here. We're just up around 100% or just under 100% versus back then it was 200%. So I think we have to keep that in mind. I also think that if you look at what the Fed has said, you have to be very careful here. So we do know that the SEC continues to sue and kind of put down regulation or the beginning structure of regulation in crypto. And then the Federal Reserve just came out recently and said, hey, guys, we expect a slight recession. And if you're anyone like me and you hear slight and the Fed saying slight and they said transitory and we saw what happened, you have to be nervous about risk assets in the future. And that's where I am. I honestly think that stock market's getting ready to have a second half that is going to be atrocious. And my guess is it drags down crypto as well.
I've been hearing, look, a lot of people in the comments section of my channel have been saying, why are all your guests bearish? What's with all this FUD? Can you get somebody bullish? And look, I'm not controlling the narrative. If people want to be bearish, that's their call, right? So you're calling for an atrocious second quarter. Can you give us any good news in the markets whatsoever? Just for the people who want some bullish news.
Well, David, let's talk here. So here's some positives. So when we met in December and we had our live interview, you asked me what my favorite asset was for 2023. What did I tell you?
I think it was gold, right?
Absolutely. And gold has been a rock star. It's not outperforming Bitcoin at this point. That's true. But it has been an amazing mover off of the lows since the start of the year. And it honestly is going to go higher. You have all the makings for it. I mean, basically, if the Fed gets inflation under control, then you still have the case where It's probably because the economy's collapsed or in a recession. And again, that would then make people less likely to spend money. But again, that recession is a kind of a scary situation. So gold goes higher. If the Fed can't get inflation under control, gold goes higher in that scenario as well. So I'm still bullish on gold. Sure, it's had a big run, might get a pullback. We've had a little bit of a downtick, but I think by third quarter, you break above that 2075 level, and you're off to the races at least to 2100 by 2300 by year end.
Why has gold moved in the same direction as stocks? Remember, now both gold has done very well. You're right; it's breached $2,000, but so have stocks, right? So let's talk about the stock market, and then we'll get into your economy. Gold and stocks. What's with the correlation?
Yeah, good question. So the biggest thing for me is when you look at yields and the dollar, right? So if you look at the yields, and in fact, we'll go to the 10-year yield right here. Okay, so the 10-year yield topped out last October. The dollar topped out last October. When did the stock market top out or bottom out? It bottomed out last October. So as yields have fallen, that's bullish for gold as well. As the dollar falls and pulls off of these highs, that's also bullish for gold. So you have those two things that the stock market right now likes, and also it's good for the bull case for gold. And I think lastly, you have to just be in the camp where you say, okay, inflation, yes, it's come down, but it's still elevated. And therefore, that's also a bullish case for gold as well.
So do you think that interest rates this year will grind higher, or will they stay the same? Because I do know that real interest rates have a direct impact on gold. Those two variables have been traditionally negatively correlated with each other.
Yeah, so at least for me on the 10-year chart has this trend line here that we've bounced off of. My guess is we're headed back down there by the second half of this year. That would be around 3% on the 10-year. So I actually think there's further downside on the 10-year. Another ETF that's a great way to follow it is when yields go down, the TLT tends to go up. It's kind of an inverse ETF here. And you have this beautiful sideways channel of bullish consolidation, which eventually tells me that the TLT will move up, which tells me yields go down. The only way yields are going down is if we do get a recession or at least a slowing economy that's significant, which then basically makes the Fed potentially have to start backing off their rate hikes in the second half.
Okay, but why do you think yields are going down? Is that a reflection of your outlook on the economy?
Yes, yeah. So it's not so much a matter of my views on inflation. I think that for the most part, inflation is going to come back to about 3% and be very, very sticky there. And that's going to be problematic for the Fed because they can't really stimulate in a massive way when inflation is at 3% already, because you stimulate at 3%, we go to 12%, 15% inflation off of the same type of money printing that they did in 2020 through 2021. So in other words, it's most likely the mere fact that you're going to see the economy really stutter. I think you get into a recession in the second half. In fact, the Fed basically said that just a week ago. Interestingly enough, the stock market has ignored it. Risk assets have ignored that. But again, the Fed is telling us exactly what they're expecting. And I always look at it like it's going to be worse. If the Fed says something, always think 3 steps worse than what the Fed is telling us.
Wait, what did they say exactly? They said there's going to be a recession?
Yeah, they said last week, they said to expect a minor recession. A minor recession, or I don't know what the term was, but it was basically like, oh, just a tiny recession. But again, if you're like me, and I said this at the beginning, remember, they were like, oh yeah, we'll have inflation, but it's transitory. So it's one of those scenarios where, to me, they always try to sugarcoat because they don't want to scare the markets and cause a collapse. But smart investors have to start prepping for a worse recession than what they're saying. And again, that's just risk management.
You're right. I'm just reading the article now. They said mild recession is expected later this year. Federal Reserve
absolutely.
Says.
So
recession.
In other words, it's probably going to be a mid-level recession.
Wow. So, okay. That is a shocking statement, actually, for the central bank to even admit that there would be any recession. Typically, they want to avoid statements like that because that spooks the markets, which is even further surprising even to me, because the stock markets continue to ignore that. Like you said, I don't know what you're a trader, you're an investor. When you hear a message like that, what's your move? What's your go-to move? Do you short the markets? Do you do nothing?
Yeah, well, there's no doubt about it. I've been inching into shorts. And again, I'm one of those types of people that as a trader, I've learned my lessons in the past. So I inch into positions. I don't go all in. So I've just been inching in one toe at a time in the water here on the short side of the market, a little bit of the Qs short, a little S&P short, and kind of just preparing for what I think is coming. And I also think going into earnings season, I mean, we're basically just starting earnings season now. There's going to be a lot of a lot of negative revisions, in my opinion, or lowered forecasts. And that's the market, to me, is not prepared for that. If you look at like the forward PE of Microsoft, the forward PE of Apple, there's no preparation for any type of recession in that valuation. And that will have to reset at some point when the market comes to that realization that the Fed is telling the truth, that there will be a recession.
What signs, indicators have you seen yourself, either from the data or with your own personal life and your observations, that may point to a recession in the U.S.?
Yeah. So the first thing, and this again, the market has an amazing way of ignoring it. And one of the topics, or one of the things I always say is the markets don't care until they care, right? So last week on CNBC, I happened to catch Warren Buffett saying that he has a retailer that he owns, right, and that Berkshire Hathaway owns. Year over year, their sales of this retailer were down 22% year over year. So to me, that was a shocking statement. I mean, that is a massive decline in revenue, and the market again ignored it. Nothing big, nothing to see here, essentially. So those type of things I'm picking up when you have big players that know what they're talking, the David Teppers, the Warren Buffetts, these big name hedge funds that you have respect for because they're accurate. That's what I pick up on out there. And then also the charts. I want to show you something. All right. This is one of the most shocking charts to me. You're probably going to recognize it here. So let me just bring up this chart. All right. And I'm sure you've seen this before, David. Yeah. This is the psychology of the market chart. Right. So basically you have this run up. And to me, this run up that we've seen looked very much like the run that we saw from COVID all the way up to 2021. We then had this sharp decline here. Now, look at the price action that we're seeing here in this psychology of the market chart. It's a lot of sideways to slightly up. Now, if I flip back to my S&P chart, okay, let's go back to this chart, and I want to go to my weekly chart. Look at what we've done here, okay? You have the same sort of sharp move up, getting to euphoria, the sharp move down. There's even this little pivot where we had a lower low, and then sideways consolidation. And so again, if you look at this down move and this choppiness, this is exactly the part within the psychology of the market that is going to tell us that this is the next down move to go. And just to reiterate, I want to switch back to that chart. Just remember what we just saw right there. And that's this part. We're right in the midst of this complacency period where people are saying, oh, it's, the bull market was so great. I want to revisit that. It's going to come back. I really hope it comes back. Let's just sit and wait here. And that's what leads us to this next period of downside via psychology of the market chart. So amazing how accurate and how the chart of the S&P 500 here follows this to a T, the complacency chart portion.
I don't understand what people are being complacent about. I mean, you've just outlined a case for a recession. We are expecting earnings compression. What's driving complacency?
I could say, listen, no. See, I could say I'm complacent, or I could say that I'm expecting a recession till I'm blue in the face. The question is, does the market reflect that? And the answer is the market. We just talked about how the market's ignored that what the Fed said last week, what Warren Buffett has said. I mean, the market says, who cares? We're going to be fine. Let's just keep putting money into the market here because we'll see the all-time highs. I mean, look at the crypto markets right now. They're as bullish in the crypto markets as we were when we were at 69,000. That's how quickly we've got back. That's complacency. They're basically saying, hey, listen, we're going back to all-time highs. To me, that's a red flashing warning sign out there to be very careful in this market.
Yeah. I want to talk about earnings, actually, just drill a bit deeper. So are you expecting earnings to compress across all sectors, or do you think certain sectors will do better than others?
Yeah, I mean, I think that for the most part, for instance, JP Morgan, Bank of America, some of the bigger banks, they were a recipient of money flow, obviously, from the crisis, the banking crisis, from regionals. They're able to hold up in the face of a lot of this stuff. So there's going to be pockets where they're going to do okay. But overall, I think when you go to tech earnings, like Apple's going to be really interesting to me. We've heard some warning signs from Apple over in China and so forth. Remember, when people start to get a little bit behind on bills, and for instance, I just read an article talking about how there's a huge lag now. People are behind on their auto loans significantly. So when you come to upgrading your iPhone to the next cycle, are people going to start to just choose to wait 6 months? That could be a massive impact to the earnings on Apple. All right. Same thing with Tesla. If money starts to get tight, I mean, we've seen Tesla cut the price of their cars, 5 times in the last month or two. There's a reason that's happening. Number one, competition. Number two, people aren't running out to spend the levels of money on a Tesla that they were a year ago or so. So there are signs out there. You could talk about job cuts at Amazon. You could talk about job cuts at Google. There are signs that Wall Street, these big players, are starting to tighten their belts. To me, that's an indicator I need to be careful as an investor.
It's interesting you brought up the banks. Goldman Sachs reported a miss on earnings just today as we're speaking. So you're right. The banks are taking a hit, not so much from the banking crisis, because this was earnings from last quarter. The banking crisis was just recently. But let's talk about the banking crisis just for a little bit. It seems like it's been out of the news for a bit now. It seems like the fear has more or less subsided over the last 2 weeks at least. Jamie Dimon has said that this is not the end of it. So has Larry Fink. What do you think? Do you think more banks are on the line?
So another example of the markets ignoring what he's saying, right? So again, you have Jamie Dimon, who runs basically one of the biggest banks in the world, and he's telling you this is not over. Yet the markets are like, nah, it's over, no big deal. Let's keep buying the S&P 500.
Or the market just thinks he's a liar. The market just might think he's a liar.
I mean, maybe that's what it is. But one of the things I would show people is look at the KRE. All right, if this is over, why is the KRE, which is the regional banking ETF, having literally no bounce here? I mean, this is, to me, a classic case of a bearish chart pattern, and that's got to be very concerning, the fact that the regionals still are not getting a bounce, especially when the Fed basically came out and said, hey, or the government said, hey, we'll make sure that depositors don't lose money, all these things. You even got a bunch of the big banks to put a ton of money in FRC, and here we are. The banking ETF for the regionals is basically at its lows. So there are things cooking here that, to be honest, right now, I would be shocked if we have not dropped significantly within the next 3 months in this stock market, in the S&P, in the NASDAQ.
Okay, so let's get your goalpost for the S&P. You're talking about an atrocious quarter for second year. The audience wants details.
Second half,
what is
yes.
Second half of the year.
So I'm really expecting the big downside to come in the second half. And my case for that, my thesis for that, is that it'll come when the market finally is recognizing that a recession is on the horizon. And the way they're going to recognize that is we're going to finally see the jobs numbers really start to crack. Right. So if you look back at the ADP jobs number, it came in a little less than expected. We've seen non-farm payrolls, continuing claims a little bit higher than expected. It's starting to crack, but we haven't seen it to the extent that the markets are getting scared yet. I think by the second half of this year, absolutely the market comes to that realization. Then all of a sudden, now that once a recession is the norm, you have to see repricing of assets like an Apple, like a Microsoft, like even a crypto, to get down to levels where it makes sense.
Why do you think the markets are in denial about this recession? I mean, look, the fact that it's not priced in yet tells me a couple things. One, that investors in the markets generally disagree with the viewpoint that a recession is coming, which is the viewpoint that you share. Or number two, they're in denial about it and they just don't care. Or number three, there's no recession at all, right? So what's the most likely outcome, you think? Or possibility?
So I think, honestly, you have a series, right, where we just went through this period of 2020 of COVID all the way through 2021, almost to 2022, where the markets, and again, this goes back even 10 plus years prior, where we've always been in a market. We are kind of a drug addicted market where we've always got new drugs from the Federal Reserve if there's any hardship, aka 2018, the Fed started to raise rates. Before you knew it, the market freaked and they were cutting rates. All right. So the market is kind of in this phase of they say, hey, listen, even if it gets a little rough, we're going to be rescued. Everything is always about the government, the Federal Reserve rescuing us. So let's just keep going in. Why would we believe anything else? And you can't fault people for thinking that way. They've been conditioned to think that way. But to be honest, that was when inflation was lower than 2%. I'm skeptical that we're going to get the same sort of bailouts that we saw in the next period. And again, I do think that a recession will come and the market is not prepared for it.
What kind of decline are you expecting again?
For me, I would expect by year end, maybe 3,300 on the S&P 500. Early 2024, you're talking 3,000, and eventually it could be even worse than that. But right now, let's stick with 3,300 and 3,000.
Do we retest COVID lows?
Yeah, eventually, I think we will. Absolutely. To be honest, that's a stinging kind of pivot low on a chart technical basis. At some point, we will retest that. I don't know if it'll be in the next 6 to 12 months, but I do think eventually we do retest it.
Do you think the markets are pricing in a Fed rate cut or renewed quantitative easing by the later part of the year, which is why markets keep going up?
I think that's part of the hope, right? Is that the Fed comes to the rescue, that if we do see the data weaken that much, I think a lot is going to have to do with that inflation. Where is inflation at that point in time? And then also, how bad does the recession get? If it's just kind of a mild recession, well, then the Fed's not going to feel like they need to intervene because the risks of them spiking inflation, like with Volcker, is too great. If it's a very deep and nasty recession, you see unemployment going to 10%, well, then the Fed's going to have to step in, even if inflation's still at 3%.
It's interesting you brought up tech stocks. I just want to spend a minute or two talking about tech stocks. We're seeing this evolution now. First of all, this AI boom is really driving demand for chips. I know you like NVIDIA. Let's talk about NVIDIA first.
Yeah, Nvidia. So I am short Nvidia. Again,
oh, you don't like? My bad.
No,
I
don't.
apologize.
I don't like Nvidia, but that's okay.
Okay, you
Bring
don't
it
like
up.
NVIDIA.
I love it. Let's talk about this. So number one, yeah, this is the same narrative that spiked the marijuana stocks back in the day when it was going to be legal. It's the new thing. It's the same thing with the solar stocks at one point when they were new. It's this AI kind of thought process. Everyone gets excited about it, but in reality, the revenue is not going to be generated from this area for years to come. So again, it creates this spike. But if you look at the chart of Nvidia here, is a confluence of resistance points up here around this 280, 275, 285 area. And to me, the charts are everything here. And honestly, if we see a recession, cyclicality of the semiconductors tells you that they're going to see a big downside move. So for me, I'm short Nvidia here. And again, looking for a decent decline back to probably the low 200s.
Well, if you're bearish on the markets overall, then yeah, your thesis makes sense because the market's going to pull down these high beta stocks. Apple is really interesting. Just yesterday, they've announced a partnership with Goldman Sachs. Deposits now into Apple. You can actually, it's a bank now. You can 4.15% APY, which is 10 times higher than most traditional banks. So Apple is not just it's now a financial services company.
I'm still waiting for the car. When's the car coming? But yeah, I mean, to be honest, again, I look at Apple and I understand they're trying to. So by the way, if they shift into more of a bank, that's a much lower PE business. So I think that has to be taken into account too, that we look at the earnings per share for a JPM and what the PE ratio is and so forth. But listen, they're still a tech company. But again, how fast are they growing? How does it justify a 25 to 30 PE ratio going into a possible recession where people have to spend $1,300 for an iPhone? I don't get it. I think this is a play that has been used as a safety hedge where people are taking money from banks, putting it into this play because it's known to be kind of a safe haven. I think that's a mistake, and I think you'll see a big decline.
All right, well, let's wrap up your views, and then I want to spend 2 minutes talking about verified investing education because I think it's important for the public to understand what you're doing besides trading. So your Bitcoin needs to hold $30,000 for how long before you change your view?
So 30,500 is the technical level, so it needs to stay for 5 to 7 days above that level on a daily basis above that level.
How many days are we?
And then I think what's that?
How many days are we now so far?
So far 0, right? We're now just above it for the first day again. So it resets every time it comes below. So yesterday we closed in the 29,000 range. It must stay above. And one of the reasons why this is so important, people say, well, why does it have to stay above for X amount of days? Because algorithms and institutions want you to think it's broken out. I've seen this on charts of stocks, commodities, crypto, where they're trying to get you to trigger long so that you buy and they can unload their position. So the longer it stays above, the harder it is for them to utilize capital to push it back down at a certain point in the future. So that's why it's important that it stays above for a certain amount of time. So ultimately, right now, we're basically back to day one here. Let's see if it closes above, and then we'll go from there.
Okay, and stock markets, we've been over that. Gold, you're still expecting gold to be the top asset this year?
Yeah, I am. I do think Bitcoin still has a pullback coming that could be dramatic, and I do think gold is the best performer by year end. We'll see if I'm right. We got to have our live interview again end of year, and we'll decide.
Yeah, we'll do that. Yeah, we haven't talked about oil in detail, but just very quickly, are you factoring in energy into your decision as to whether or not that's going to be the best asset?
Yeah, so far I'm really honestly neutral on oil. It's traded off the lows here. It's just consolidating. I don't really have a viewpoint here. I do think that in the second half of the year, you're probably going to see some downside if we do see that recession come to fruition. But right now, in the next few months, it's hard to pinpoint directional here. I do continue to like nat gas. I've been liking natural gas for a while. It's just been so beaten down. We are seeing another update today. Today would be the third update in a row, so it's getting a great technical bounce. But I continue to be bullish on that.
All right, I want to talk about technical analysis and verified investing education. So for people who have never seen our prior interviews or heard about you before, you also run a education service called Verified Investing Education. I want to bring this story up to you. I want to get your reaction, okay? Because I think there's a lot of perhaps misunderstandings or misconceptions about technical trading or technical analysis that needs to be addressed. A lot of people don't know what it is in the public. I just interviewed Eugene Fama. Huge respect for his work. He's widely regarded as the godfather of corporate finance, modern corporate finance, Nobel Prize winner for his work on the efficient market hypothesis. And I spoke to him about, a lot of things, but I asked him about technical trading, technical analysis, because one of the theses of his efficient market hypothesis is that you can't predict prices going forward based on historical price patterns. So I asked him, what do you think of technical analysis? And he said, junk. His words, not mine. Don't shoot the messenger. And he told this story. I want you to address this. He told this story. There was this very famous story of a professor at a school. I can't remember which one. And then he went to a faculty lounge and he showed his colleagues this random chart. He says, here's a chart. Make predictions based on this chart. And everybody gave predictions. And then he said, yeah, I just made these numbers up. And he used that story to illustrate the point that it doesn't work. What would you say to somebody like him?
Yeah, so basically what I would say is that I'm living proof. I have traders here live in office that are living proof as well, that technicals work. We win about 80% of the time. To me, it's never going to be 100%. It's all a probabilities game, but there are signals in the charts. And again, one of the reasons the charts actually do tell you or guide you to the right direction that a move is coming is that they are a representation of human emotion, greed and fear. And so what you can start to do is look for the setups that essentially tell you that greed is topping out or fear is bottoming out, and ultimately go counter trend to that. And again, my bank accounts, my trading accounts, I speak to other tunes in terms of what he's saying. But again, the beauty of it is, I always say, everyone out there that's listening, watching, just go look at it for a little bit. Go look at it. Come join. Like you said, you mentioned Verified Investing Education. I have the Winning Trader series. If you get through that and you don't think that it works after I show you the craziness that I'm going to show you in that series, then nothing I can say about that. But I will tell you, and David, one day I'm going to get you in office and I'm going to show you some stuff that will blow your mind. Lastly, I'll say this. If technical analysis doesn't work and that's the only thing I do, how did I make all the calls that I've made with you on the different charts of crypto stocks? I must just be the luckiest guy in the world.
Yeah, I mean, you have made a number of very important calls. What can people expect to gain from your course at the end of your services? Because, you were successful not just because of your knowledge, but also because of your experience. Somebody can learn from you and learn the theory, but still not have your decades of experience, right?
Yeah, the experience is something that for the most part, I can't transfer. That's just 20 plus years at this point. But what I did do is in the Winning Trader series, I put down all of the techniques, all of the analysis tools, all of the setups, and even the secrets that I've learned over 20 years into that 3-course series. And so basically when people take that, they're getting a jump start. For what took me 10 years to develop, they're able to learn it in a matter of months and then practice it. So you're basically cutting down your learning curve. So essentially you're able to get to my level within a couple years versus what took me 10 plus years to achieve.
All right, Gareth, that was fantastic. Thanks very much for sharing your thoughts with us. And I'm sure the audience is impatiently waiting for your updates. So thank you for that.
Thank you, David, so much. It's always a pleasure to chat, and congrats on the new show. It looks like it's going awesome.
Thank you. Thank you for all your support. And I look forward to speaking with you next time and getting your updates again. And thank you for watching. Don't forget to subscribe.